us understand the day's currency movement. Latha, clearly a lot of factors that are affecting this, but how do you see this panning out in the days to come?
Well, in the first place, we are very sensitive to crude. So crude rising 3% today, and in fact maybe almost 6% this week, was clearly a rupee negative, increases the current account deficit and hence the pressure on the currency. But it's not alone. There has been a synchronized fall in emerging markets, equities and currencies. The yuan has been depreciating, and even to compete, the Indian rupee's slide is good. And I wanted to emphasize that this is a good slide. It's not something that's spreading mayhem and panic. It's happening gently, and it's happening competing with other emerging markets with whom we compete on trade terms. Now, one reason why the EM currencies are falling, especially the yuan, could also be that their own central banks are allowing it to fall. Aside from the trade tariff tangles that are putting pressure on the Chinese economy, after all, the Shanghai index also is down, in bear market terrain, down 20% this year. The emerging market central banks would like their currencies to fall to make up for the higher tariffs that the countries are facing. It neutralizes the higher tariffs to some extent. So this could also be a fall which is welcomed by the central banks, and therefore they're not fighting it. Again, for India itself, it's not just the crude fall. It's also that foreign funds have been deserting Indian markets for some time now, and now you feel the pinch because you're also paying a higher import bill for crude. Sentiment also is against the rupee. But 69 is not a long way from that 68.80 that was yesterday and the 68.60 the day before. So it's been a gentle fall. Importantly, we should note that while rupee may be the worst performing 8% fall in 2018, it compares to like 7.5% for the Indonesian rupiah or around 7% for the Filipino peso. So we are not singled out. And if you compare us to the ruble, the real, the Turkish lira, some of them have fallen between 15 and 20% in 2018 itself. That's the 2018 comparison. If you take the 5-year comparison from the taper tantrum onwards, the rupee has been flat. If you compare it to August of 2013, we are flat. Whereas most other currencies, the ruble, for instance, has depreciated by 100%. The Brazilian real, the Turkish lira, all of them 160, 180%. So actually the rupee is a picture of stability, and this weakness is something that perhaps is merited by the macros of the country. But is this a good fall? What will it do to the economy? And is there more to come? We have a couple of experts joining us. Sajjid Chinoy, the chief economist at JP Morgan, is with us, and Alvin Tan, the currency expert from SocGen, has also joined us. Gentlemen, thank you very much for joining me. Well, first, Sajjid, before I come to the macroeconomic impact, let me ask Alvin, rupee is only a tad underperforming other emerging market currencies. Would you worry that this could become a little manic at all, Alan?
Yes, of course, there's always that worry, but I do share the sentiment that the rupee decline is not particular to India, certainly. There's a bigger global macro move here in the dollar among emerging market currencies. So if it does get a bit more manic, as you say, it will be due to these global factors rather than Indian-specific factors.
Yep. Okay. Well, let me get a similar reaction from Sajjid Chinoy as well. Sajjid, is this worrisome or is it welcome?
Well, it's a bit of both, Latha. I mean, just understand the larger global backdrop here. We've had a dollar that strengthened almost 7% in the last 6 weeks, number one, both because of desynchronized global growth and because of fears of a trade war. All emerging markets have come under some pressure. I would argue India is much more fortified than many other emerging markets, as well as 2013. But what's interesting is in the last 10 days, something different has happened. First, you had the emerging market current account deficit countries come under pressure. Argentina, Turkey, South Africa, Brazil. The last 10 days has been predominantly Asia. Right? 6 of the worst performing currencies against the dollar in the last 10 days are Asian. So this is very much reflecting the regional fallout from a tariff war between China and the US. I think that's the backdrop here, number one. Number two, we've seen that China's growth has slowed into mid-year. That, compounded with concerns of a trade war, have caused Chinese policymakers to consciously ease policy. You had a reserve requirement cut over the weekend and some currency weakness. Now that's the context here. If the dollar is strengthening and the CNY is depreciating, every other Asian country will want to follow suit, and therefore central banks have been permissive of this. In India's case, I think this is very much calibrated, no panic. We're in the middle of the pack. We've done better in the last 10 days than most current account surplus countries in the region, so there's no fear here. But the concern is that if the dollar keeps strengthening and CNY continues to weaken and there's some capital flight out of China, then what is a calibrated move could potentially become disruptive.
Alvin Tan, will that happen? The scenario that Sajjid is drawing out, continued strengthening of the US dollar and depreciation of the yuan.
Well, I think what's quite interesting, we're talking about the last several days, is that the DXY index, which is the broad dollar index against major currencies, actually fell between last Thursday through this Monday. This is when euro dollar bounced from 115 to 117, if you remember.
Yeah.
And interestingly, in that time period, the dollar CNY was actually going higher. So indeed, there is some evidence that Chinese authorities might be using depreciation as a policy tool to counter this escalating trade tensions with the United States. And indeed, if this were to continue, it could see a return of what we saw in 2015, 2016, when Chinese depreciation actually shifted expectations among Chinese investors, prompting them to move money out of China. So that is indeed the danger going forward.
Let me persist with this central bank issues and then come to Sajjid on the Indian impact. The Indian central banker Urjit Patel had also raised in Financial Times, in a Financial Times article, the possibility that the Fed unwinding its balance sheet or shrinking its balance sheet at a time when the US fiscal deficit is rising could demand that more dollars come into US bonds and therefore an outflow from emerging market currencies. Separately, if you're saying that the Chinese depreciation could become a flood like one saw in Jan 2016, first of all, what are the chances of that happening?
Okay, I'll take that question. I think, first of all, what is different between now and 2015, 2016 in China is certainly that they have tightened up the capital account situation. So there are a lot more restrictions now. So that's the first thing to note. But the chances, I think, of that risk is high. It's from a combination of trade tensions escalating, number one, and also it's also worth mentioning that Chinese equities have suffered quite significantly since January. I mean, Shanghai equity indices are down about 20% since their January highs. So separately from what's happening in the currency market, Chinese investor sentiment has clearly been shaken in the equity market. Now, what is holding up Chinese assets at this time are property prices, which are still generally quite well supported. But if that were to go, and in tandem with further depreciation of the renminbi, that could indeed spark another capital exodus out of China, notwithstanding the stronger capital controls they have now.
So that's not your base case. You don't expect a manic Chinese depreciation and emerging market or Indian currency depreciation? What would be the odds for that at all? Alvin.
Yes, that's not our base case. I think the odds of that are not insignificant. I would place them at approximately 20–30%. Basically, I think the big question mark in the next week or so is whether the US will go ahead with the imposition of tariffs on the targeted 50 billion of Chinese imports. That decision is supposedly coming next week, July the 6th. Of course, before that, tomorrow, we will hear from the U.S. Treasury Department on what kind of investment restrictions they will be placing on China. So that's the near-term issue. We continue to think that the Trump administration will be seeking some sort of broad agreement on trade rather than see an escalation of the outright trade war.
Okay. Well, Sajjid, now to come to you, what does 69 on the rupee mean at all? Are you seeing a worsening of current account deficit, fiscal deficit, inflation?
Latha, I'll just first say that I don't think it's very meaningful to look at the bilateral rupee dollar rate. Those are going to make new highs because India's inflation is higher than other countries. I think the right measure here is to look at the trade-weighted rate. And what you'll see is India had a 20% real appreciation between 2014 and 2017. Yes. In 2018, about 7% of that has reversed. So in fact, the rupee is stronger now than 4 years ago. And therefore, some calibrated trade-weighted depreciation is not a bad thing for this economy, for the underlying competitiveness, number one. Number two, I think we're much more fortified than 2013. Macro fundamentals are better. The twin deficits are still higher than last year, but nowhere near where they were in 2013. And we've got significantly higher buffers. The central bank's got reserves. The reserve cover is 1.5 times that of 2013, and the RBI seems able and willing to use it. So no reason for any panic. This is a global move. India is in the middle of the pack. Where are the vulnerabilities? I would argue it's on the current account. If oil is going to be creeping towards $80 a barrel, the current account for this year will be closer to 3% of GDP, about $80 billion. How does one finance that, especially if you are seeing portfolio outflows from all emerging markets? That's one challenge. I think ensuring we stick to our fiscal target so that there's no more pressure on the bond market later in the year is also something we need to be very particular about. So yes, are there pressure points? There always are. But I think compared to 2013, we're much more fortified. And today, India is still regarded as one of those emerging markets which are much more, in a better position to handle global stress than many of our other peers.
Okay. Well, Alvin, Tan, if you can just leave me with a range and an average of the dollar rupee for 2018.
Well, actually, over the next 3 to 6 months, we are expecting dollar rupee to move up above 70. So we're looking for dollar rupee at 70 in the first quarter of next year. Okay. But I echo the sentiment that that move itself is not problematic.
Fair point. Sajjid, 70?
Oh, Latha, this will depend entirely on the dollar. If the dollar were to strengthen 4 or 5% from here, all EMs are going to come under pressure. So there's no sacrosanct number. Sure. Conversely, if the trade war doesn't materialize and the dollar weakens, the rupee could go the other way. So I think any bilateral, rupee dollar number, ad hoc number, I think is not meaningful, given that central banks look at the trade-weighted exchange rate.
Fair point. Gentlemen, thank you very much for joining me. So a perfect storm if the US administration were to persist with the restrictions on Chinese investment, with that $50 billion packet of tariffs, and if the dollar were to rise. But that perfect storm may not happen. Political systems and political economies are usually dynamic and could diffuse that crisis. But at least in India, the expert view is that this is really not worry time.
Okay.